Clifford, good to have you back with us on the programme here. Could you just sum up the quarter for us and give us a sense of where current trading is going?
Well, good to be here. We're based here in the Netherlands, which is a resilient economy in these difficult times. So we're outperforming the Eurozone as an economy. And that's true of ABN AMRO, whereas our operating performance is resilient, but impairments are still high, although down on Q1. So around break-even result for Q2. We expect impairments again to be high for the rest of the year, but again down on the first half of the year. And that leaves the bank resilient. Our capital position is very strong. So we're feeling comfortable and resilient even in these difficult times.
Can you tell us a bit more about the impairment charges you're taking at this point? What does that reflect? Where is the issue?
Yeah, the impairment charge for Q2 was around 700 million euros, and that's primarily in our corporate bank, which operates in Europe and around the world. We've announced today the outcome of our review of the corporate bank, and going forward we'll be focusing on Europe and winding down our activities outside Europe, and that will improve the risk profile of the group and build our capital further going forward.
What does that imply in terms of the upside potential when we come through the other side of COVID-19? Because this phenomena of de-risking in European banks it all seems very positive when times are tough and we're facing difficult economic conditions. But as we come through the other side, it obviously limits the potential for higher profitability.
Look, I'd raise a couple of points here. As part of the outcome of the CIB review, we're focusing the bank on the Netherlands and Northwest Europe, where we'll continue to invest and grow. And over time, we see good opportunities here as we get through this cycle. And from an income and capital point of view, we're well placed to resume dividends when the ECB's recommendation this year not to pay dividends is expected to expire. So our capital position is strong and we're well placed to resume dividends and in due course return capital when conditions allow.
But what are the implications for the bank from the other steps that you're taking? I mean, your trade and commodity finance activities will be discontinued completely. Natural resources and transportation and logistics will focus on European clients only. I mean, it does feel as though the bank is pulling in its horns in a number of areas here, and that will have implications going forward for how profitable the bank can be.
Yeah, I'd raise 3 points. I mean, the corporate bank is around 10% of the bank. Those sectors outside Europe are around 10%. And what we'll be doing is focusing the bank on Europe, which is a big market where we have strengths, and we'll continue to invest and grow here across our businesses. We're de-risking the bank as a whole and strengthening the capital position, and we're aligning the strategy of the corporate bank to the rest of the bank, and we expect the corporate bank to work closely with, for example, our private bank here in Europe, and we see upside from that going forward.